Good afternoon. This week the market screamed about two things: a $20 Chinese model that matched the frontier and a hot war in the Persian Gulf. Both are loud, both are real, but the most important number nobody put on a chart is a minus sign sitting in front of big tech's free cash flow. For 2 years the artificial intelligence trade had one rule: the more you spent, the more the market loved you. This week, that rule started to break. Let's get into it. Here's the board. Stocks fell on the chip rout. The S&P closed down about 1% near 7,458. The Nasdaq down 1.5% as semiconductors led. But look at the third tile. The chip index is now in a bear market, more than 20% below its June record, while the broad S&P sits only about 1% off its high. That gap is the whole story. This is a concentrated repricing, not a broad crash. Now the crosscurrents. The 10-year Treasury yield sits at 4.5%, but it's bid on oil, not growth. Fresh United States strikes on Iran and a near shutdown of Strait of Hormuz tanker traffic pushed crude up about 4.5% and up 14% on the week. And here's the tell inside the tell. Gold is near its all-time high, yet it went nowhere on a week with a live war headline. That only makes sense if the market is reading this oil move as inflationary, not as a reason to run for safety. Bitcoin is quiet near 64,500. Hold that gold detail. It comes back. Now the signature segment, consensus versus the read. First, and this is today's deep dive. Everyone believes the way to own the artificial intelligence boom is to own the giants: Microsoft, Alphabet, Meta, Amazon, but the analysts at IO Fund flag something the crowd is ignoring. Across those four, capital spending is now rising much faster than the cash the businesses actually generate. Their estimate: these names turn free cash flow negative, one by one, into 2027, and the single biggest spender is already there. When your favorite compounder starts burning cash just to stay in the race, the profits don't vanish. They migrate to whoever sells the picks and shovels. Networking, energy, and memory. High conviction, and Frankie takes the whole thing apart in today's focus. Second read, the other panic was China. Moonshot's new open model Kimi scored at or near the frontier for pennies, and the crowd said the same thing. The American lead is gone, sell the whole complex. But cheaper intelligence is the biggest cost-cut software has ever been handed. It is deflationary for the company selling the shovels, the chip makers, and a gift to everyone who buys intelligence to make a product. And one honest caveat: Kimi's headline score, 81% versus Claude's 76 on one benchmark, is the company's own number, and working developers say it doesn't fully hold up in real-world coding. The China one meme is running ahead of the evidence. High conviction on the mechanism, medium on the benchmark. Third read, in crypto, a prominent investor said this week that the big market structure bill, the Clarity Act, is basically done, just wordsmithing an ethics clause. The tape disagrees. The bill is stalled with no Senate floor vote. Prediction market odds have collapsed to about 43%, and there are 3 unresolved fights, not one, against an August 7th recess deadline. The bull's marquee policy catalyst for 2026 is slipping past the calendar. And Bitcoin drifting at 64,000 with no tailwind is telling you exactly that. Medium-high conviction. Follow the money. The thread that's actually moving rates is the war. Fresh United States strikes on Iran, an 8th straight night with 2 service members killed, and a near shutdown of Strait of Hormuz tanker traffic, bid crude up about 4.5% and 14% on the week. That is why the 10-year yield is where it is, not growth, oil, and it's why we keep flagging gold. On a genuine war headline, the classic safe haven went nowhere. The market is treating this as an inflation impulse, more reason for the Federal Reserve to stay patient, not a flight to safety. So the swing variable for the whole disinflation trade is not a data release. It is the Strait of Hormuz. Watch Brent above 88 as the line where the inflation trade gets repriced in earnest. Here's the regime shift underneath all of it. For 2 years, the market rewarded spending. The more computer company bought, the more it was loved. This week the question flipped. Not is artificial intelligence real? It is. The question is now who captures the value now that the intelligence itself is getting cheap and the build-out is eating cash. And you can see the vote in the flows. Out of the capital spending complex. The chip index into a bear market. Oracle's cost to insure its debt at a record high on artificial intelligence spending fears. And into the suppliers and the capital return names. Two respected macro voices leaned defensive into the very same week. One warning that global liquidity is rolling over, the other saying, simply, you don't own enough cash. A word on sentiment and positioning, because it's the mirror image of the data. Our market and social sentiment monitoring shows the commentary crowded almost entirely onto one story this week. Cheap Chinese model, the bubble popped, rotate to safety. What that consensus skipped is telling. Almost none of it sat with the fact that Taiwan Semiconductor, the company at the dead center of artificial intelligence, just posted a record quarter and raised its guidance, and got sold anyway. When positioning is this one-sided and the details cut the other way, the details usually win eventually. Here's the single most revealing data point of the day. Taiwan Semiconductor, the company that physically makes the world's most advanced chips, reported this same week. Operating profit up 77%, a record quarter, and it raised its guidance for the whole year. That is the company at the center of artificial intelligence telling you, out loud, demand is speeding up. The textbook says the stock rips. Instead, it fell about 7%. When the best possible earnings can't lift the stock, you are not looking at a demand problem. You are watching the market reprice what it's willing to pay for the build-out. That flip is the most important thing that happened this week. Sectors in play, three of them. First, semiconductors, and this is a split, not a crash. The scale leaders, Taiwan Semiconductor and Nvidia, can absorb higher spending and outrun a cheaper rival. The commodity memory tier, Micron and SK Hynix, cannot. Second, the artificial intelligence suppliers, networking, energy, and memory. If the hyperscalers' cash flow really goes negative, that spending is someone else's revenue. And a nuclear reactor restart to power a data center this week is that trade made literal. Third, and away from the noise, weight loss drugs. A new Gallup survey shows 11% of American adults, about 40 million people, now take one, quadrupled since 2024, with the obesity rate falling. That is a durable, second-order reshaping of food, restaurants, and snacking, and it is not a fad. On the radar, 5 things worth your attention. First and biggest, next week's big technology second quarter earnings. Microsoft, Alphabet, Meta, and Amazon. This is the cash flow versus spending verdict. Do the giants show the build-out converting to profit, or do they confirm the cash burn? That single question decides whether this rotation extends or reverses. Second, on July 27th, Kimmy's full open weights release, the real test of the benchmark claims. Third, oil and the Strait of Hormuz, the swing factor for rates, and the whole inflation story. Fourth, the Clarity Act against its August 7th recess clock. And fifth, whether the fear gauge breaks above 20, which would tell you the market has stopped seeing the war as contained. The scorecard, where we grade the dated calls, including the ones that go against us. 3 new calls go on the record today. 1. Over the next month, the artificial intelligence supplier names and the capital return names hold up better on a relative basis than the capex-heavy giants. That's falsified if the giants beat and lead the whole complex higher after next week's earnings. 2. At least one of the big 4 guides to rising spending without a matching cash flow story next week, and the old spend more win more reflex fails to reward it. 3. Gold holds its record zone near $4,000 as an inflation hedge into the oil shock, and we are deliberately not putting a percentage on gold. Now the carry forward. Last issues read that the chip route is a repricing, not a demand crash, is tracking. Taiwan Semiconductor's record but sold quarter is the evidence. The most expensive habit in markets is mistaking a price move for the news that caused it. This week the news was deafening. A cheap Chinese model, a chip route, a hot war, gold pinned at $4,000, and the crowd wrote the easy headline, "Artificial intelligence is over." But the company at the center of it posted record earnings, and a cheaper model just made intelligence more useful, not less. What actually changed is quieter and bigger. The bill for the build-out is coming due. So here's the one to sit with. If owning the boom used to mean owning the biggest spenders, what does it mean now that the biggest spenders are the ones burning the cash? Today's focus goes deep on exactly that. The asymmetric signal. One contrarian read a day. Subscribe.